Good morning, good afternoon, good evening, folks. Michael Zuber, One Rental at a Time. And this is going to be a video that everybody needs to watch. And yes, I know my camera is flickering. I'm sorry. We tried to reboot. I decided to record the video anyway. How you doing, Jonathan?
I'm doing great.
Yes.
I'm doing great. I'm very suspicious of the fact that you're rebooting it still.
Yeah, I'm not a real person.
I think you're a hologram, a holographic projection.
I like it.
Yeah. So
yeah, that's funny. That just makes me chuckle. Hey, so we were, I cut off number 2 because I think this needed its own video. And that is, what are some of the oddities, strangeness, warning signs you see in syndications? I will share what I'm seeing. I'm an accredited investor. I get dozens a week, and they are getting worse and worse. And you were bringing up something that I had not seen, or at least not recognized. And it scares me. So go ahead.
So so let's sort of back this up a little bit. When you are doing a syndication, it is a good idea to raise a little bit of extra money than you need just for the costs that you have, the down payment and the closing costs and things like that, because it is prudent to have a reserve fund, so that you have cash on hand to make repairs that are coming up.
Yeah,
and
in
also,
case stuff. Yep.
Right. And then you don't have to take it out of your cash flow, and you can still pay your investors the preferred return, and you sort of can catch up. You can kind of be like your own bank if you have a reserve fund, right? So it's just a prudent thing to do. However, what is happening now is people are raising a lot of money, and they are using, some of it is ostensibly for their value add, which is fine, right? Yeah. But they are also now paying their investors back their preferred return. We're not paying them back, but they're paying them the preferred return out of those funds, right? Wow. They're basically saying to their investors, hey, we're raising all this extra money so that we can pay you back. We can pay you, sorry, I keep on saying back, it's not back. We can pay you your preferred return during the value add. Now, value add typically has been like the way you really do it, you're not going to be, your cash flow is going to be in not so great, because you're emptying apartments out, you're turning them, you're going to have a lot of vacancy, right? But the idea is it's all going to be worth it in the end to you, because you're going to have units that are a lot more valuable. It can be rented for a lot more money. So in the long run, this is in your benefit. You should forego some short-term cash in return for long-term profits, right? That are going to be much better. That's the idea. But now people are trying to entice investors into deals by basically saying, oh, rehab, no problem, we're going to pay you anyway. Well, where's the money coming from? It's coming from the money you just gave me. I'm just gonna
I'm gonna give it back to you in little pieces.
You're gonna give me $100, and I'm gonna give you 8% of that, and I'm gonna call it a preferred return.
Wow.
Right? And so we're seeing that is happening quite a bit, right? Another thing that is happening quite a bit is so we've talked a lot about interest only debt.
That's what I've seen. And you brought that to my attention, the dependence on interest only.
Right. To make your to get your returns to where you want them to be. So this is sort of like value add in reverse, in a sense, right? Because you're basically saying like, hey, we're just not going to get that much loan amortization over the course of this deal. So yeah, we'll pay you more cash now, but on the back end, you're not going to make as much money. And we're going to kind of hope that once this loan goes to full amortization in 3 years, that, we'll all be okay and we'll have added enough value. Now, interest only is very helpful if you're doing a value add, because of what I just talked about, because your cash flow is less. So it's good. However, people are now buying just regular, straightforward, non-value add deals with interest only debt, for 3 or 5 years. I've even heard rumors of fully interest only loans, right? I think there's some private lenders out there that are willing to do that, right?
Probably.
And it's just become kind of crazy that people, and if you think about it, it's just like adding more leverage to your deal.
Oh,
right?
yeah. And again, I kind of in episode 2, I talked about this. I want to hit it again. I am seeing the same behavior in multifamily with, oh, by the way, much bigger dollars that I saw in 06, 07. Bad debt structures being increasingly worse. The other thing I've seen recently is what I'll call unrealistic rent growth. right?
Oh,
They've
yeah.
taken historical rent growth, which is 2 or 3%, and said the last year was 10, so I'm going to do 8. I'm like, are you freaking kidding me?
I was about to talk about that too, but just to
Oh,
finish up this conversation. So
sorry.
so with, this interest only debt, it's basically like adding more debt to
Mhm.
your, to your property, right? And so, and the lenders tell me, oh, well, it still has to be, even if it's interest only, it still has to work as a fully amortizing
Underwritten, yeah.
loan. But what that means is 1.25x like coverage, right?
Yep.
And
Mhm.
at 1.25x, you are not making any money for yourself, and you're not making it. I mean, you might be paying your investors a little bit, and that is if nothing comes up on the property. It means you have no capex on the property at all, right?
Exactly.
Or you've raised a big fund and you're paying it all out of that, and you're using the cash flow to pay investors, but you're not making any money yourself, right? Because that's just not enough coverage.
No.
You need to be up, if you're a syndicator in traditional syndication deals, you need to be up at about 1.5 or 1.6, right, to really be making money for yourself. So the lenders will lend on the deal, but at 1.25x, you're not making any money. So interest only, that allows you to have some profit, right? But of course, what happens is there was a moment when that was great, but now everybody's getting that debt, which means the prices have just risen, and you've now arbitraged away that right there, that
benefit.
Spread.
Yeah,
I agree. So there's that. Then there's, before we get to the rent growth thing, which is an underwriting issue, but in terms of a structure issue, we're seeing a lot of deals come with preferred equity. Right?
Yes.
Now preferred equity, if you don't know what that means, it's sort of a debt and equity hybrid, right? Usually the way that preferred equity is structured, there's some big private equity. This is not usually like little guys get to do it. I mean, you'll see some deals that say we have preferred equity, and that's sort of simple preferred equity, and it's basic. And that's not what I'm talking about here. That's just kind of having two different kinds of equity. One is participating in the back end, and one is not, but it gets a higher preferred return, and it comes first. The preferred equity I'm talking about is usually from some very sophisticated, like family office or private equity fund. And how it works is they are going to get, like a big preferred return, like 12% a year. They're going to get a payoff when they're taken out. It's not referred to as equity, but they basically are going to get some additional points to bring their return up to, say, 15% annualized when they're taken out. They often have to be taken out after a certain amount of time, which means that you have to value add, raise the value, refinance the debt, and have enough left over to take them out, right? And if you don't take them out, then they basically get to not foreclose on the deal and wipe out the LPs, but they will take over from the sponsor's position, right? They'll boot out the sponsor and take over the deal. Wow. And so now a lot of the sponsors are kind of the numbers, right? The numbers, if you're an LP, this makes the numbers look better, right? Because these guys are not participating in the upside. Right. So there's supply. So it's sort of like debt because they're not participating much or they're participating a little bit. They get taken out, but they're usually not going to be around at the sale, right? So the LPs, if you got some private equity there, so preferred equity there, you need fewer LPs, right? You need less LP equity, and the LP equity is getting all of the sale return. So it juices the numbers a lot, makes them look really good, right? And it's great if it all works out. The problem is if it doesn't work out, you just now have an additional layer in front of you that's going to collect before you do.
Yeah.
And if they don't get paid their full nut, you don't get paid anything, right?
Exactly.
And
they jump the line. Yeah.
And now here's the thing and so it acts like debt in that way, in both the fact that it makes the deal better, it's more leverage, right? But leverage always makes the deal riskier, right? And in my brief one semester in business school, in my finance class, I remember my professor saying, how much leverage should you take? And he said, as much as you dare, right? And that was the rule. Now in multifamily, they limit you to 75%. So maybe you would like to take more. They used to let you take more before the financial crisis, but they stopped. They said you can't take more than 75% now. But so now that the market has gone haywire, people are now, they've found this like thing that sort of acts like more debt that, but it's not officially debt. So it doesn't violate your loan covenants, right? But it's, if you're an LP, you better believe that this is essentially more debt that's in front of you, with the one exception that they can't foreclose and wipe you out, right? But who knows, maybe they can in some deals, and you better be careful. Like if you see preferred equity ahead of you, you better really understand what its rights are, right? But this just adds risk to your deal. So if things are going great, you're going to be happy because you're going to make more money. But if things are not going great, it means you're going to make less money. And the thing that I really dislike about this is that these private equity firms that are investing, they're falling all over themselves to invest preferred equity. Why is that? Right? Rather than equity.
Well,
why is it?
I don't know. I'm going to guess they're seeing buying at a discount.
They know, right, that essentially they look at all these little guys who are LPs as as cushion.
Exactly.
They're like these, we can get into these deals and kind of demand really great economics for ourselves without taking the risk of equity, and basically using, so if there's a 5%, you get 75% debt and you get a 5% preferred equity slug, and there's 20% of common equity, those private equity firms are looking at you, that 20% is their cushion, because they're like,
exactly,
this thing can lose 20% of its value, and all those guys can get wiped out before we're hurt. And that's why we want to be, want to be there. Exactly. That's why they want this deal, right? Because they're saying this is safe for us because of all those guys, right? If there weren't the LPs behind them, it wouldn't be as attractive for them. So they're basically using those people as their cushion, right? So if you are an LP and you see private equity, coming in for a preferred equity slice, and they're going to tell you, oh, this is good for you because it's going to increase your returns. You have to understand that may be true. Yeah, it absolutely may be true, but you have just increased your risk in the deal. Yeah, and there's a reason why so many people are offering preferred equity.
Oh, I agree.
Because they know. Yeah, especially if you're worried about a crash, right? If you're worried about a crash, you want to be higher up in the capital stack, right? You don't want to be at the bottom of the capital stack where the equity is. You want to be higher up. So that's also why private lending is so hot right now, because a lot of those people are looking at it as like, hey, I've got a 25 or a 30% cushion ahead of me, and my worst case scenario is I get to foreclose on this, and now I've got this asset for a fraction of what it was originally worth.
Yeah, exactly.
And so,
I'm seeing it all over the place. Yeah, it's. I just want LPs to realize, people that the chances of your investment going to zero are greater than they used to be, just with the deal structures I'm seeing.
Yeah, and also where we are in the market.
Yeah,
right?
Of course.
And we know that the vast majority of deals will not go to zero. I mean, that's one of the great things about real estate, right?
Yep.
But the more complex, the more you pay, and the more complex you make it, and the more mouths that have to be fed, and the more complicated the structures are, the more opportunity there is for something to go wrong.
There will be LPs that go to zero. I just don't know. Yeah, there will be.
Oh yeah, no, I mean, I've heard a few stories, right? So, but then the last thing is underwriting, which you're now the second person I've been hearing this from, where people are, in order to hit the numbers that they need to hit to entice the investors into the deals, they are just underwriting things really unrealistically.
It's like they're not even. It's like there's not even a reality test. Some of the numbers I've seen in the last month or so, I'm like, you guys realize that this rent growth we've seen is an anomaly, not to be used as the new standard. What are you guys doing? Yeah. Jesus.
So I've seen people who I was told about people, and these are from like very sophisticated syndicators who are looking at other people's deals, who have been seeing stuff like projections of 4 or 5% rent growth through the whole 10-year hold, right? not even, I could totally understand if you're like, the market is super hot and you expect, 10% rent growth to continue another year. So you're willing to underwrite the first year at 5, right?
Right.
Like that, I understand that.
That's not what I'm seeing.
But that's not what we're talking about. We're talking about underwriting the whole thing at 5, right? And then on top of that, underwriting the exit cap rate at lower than what you went in at.
Yeah.
Right. And not at, and that's, so assuming cap rate compression and you're at the top of the market, like
just the whole shaking. It's like, this is not going
to, could assume, I would not assume it, but if I were buying at the bottom of the market, I would scenario plan some cap rate compression, right? Because if I'm buying at very high cap rates, one of the possible scenarios is that, and lots of people sort of plan to do this. They buy at the low point in the market at expanded cap rates, and they plan to sell at the top, right? So they get cap rate compression, but you wouldn't underwrite that, and you wouldn't tell your investors that, right?
No,
but
wow, yeah,
right. But now what people are doing in order to make the numbers work, they're planning on cap rate compression, buying at this point in the cycle. And this is where, like 3 years ago, people were saying, oh, we're in the 9th inning of this real estate cycle. Yeah. So now we're in like the 12th inning.
Yeah,
right?
exactly.
And so it's just, this is what we're seeing out there.
Yeah,
this is why
I saw a deal in my market, Jonathan, that my market, again, Central Valley of California, it's typically like an 8.5 cap in a normal market, and it's been trading in the high 5s recently. I saw somebody talking about seeing it go down to 4.5. I'm like, you're crazy. You're writing that into your kind of prospectus. Like, no thanks.
I mean, listen, it could happen.
Oh,
right?
Yeah, maybe.
I'm not gonna say it won't happen, but you just
that's awful risky.
Yeah, you just don't go and like use that assumption, which is really like your best case scenario, as like what you
it's the standard, right? That's the baseline.
It's also just short-sighted, right? Because you want to, as a sponsor, under promise and over deliver, right? Yeah. And if you're having to over promise in order to make the deals work, then you've got an issue.
Yeah.
Right?
This has been a lot of fun, Jonathan. Thank you for this time. Where can people find you and get part of your world?
Yeah. So come to my Facebook group, which is free. It's called the Multifamily Investment Community. And I would appreciate it if you try to join the first time on a computer, because there are some mandatory questions that you must answer to get into the group. And if you don't answer them, you don't get in, period. Like there's no exceptions to that. So you got to come on a computer the first time. But after that, you can always use your phone. So Multifamily Investment Community, just search for it on Facebook. And it's a fun group. We do lots of.
Oh, yeah. I'm a part of it. It's a great group. You ask great questions, a lot of interaction, no spam. Do yourself a favor, join, and do them a favor. Let them know it came from one rental at a time. So
yeah, absolutely. Yeah, please do. It always.
It's nice.
It's nice to see. Yeah.
Very cool. Thanks, Jonathan.
Thank you, Michael.
Mm-hmm.